Why did NFACE stock plummet 16%? Let's dive into the earnings report. If you've been keeping an eye on the stock market recently, you might have noticed that NFACE, a prominent player in the energy industry, just released its latest earnings report. And the news isn't pretty, the stock is down 16%. So, what exactly happened, and should you be concerned if you're a shareholder or potential investor in the 25 to 48-year-old age range looking for stock-related news or content? Before we delve into the details, it's crucial to remember that this decline was not entirely unexpected. In fact, we had some early warnings based on a preliminary announcement by SolarEdge. During the second part of the third quarter of 2023, they reported significant cancellations and delays in Europe, citing higher-than-expected inventory and slower installation rates. As a result, NFACE had to revise their revenue expectations downward, from an initial range of $880 to $920 million to a new range of $720 to $730 million. Additionally, their non-GAAP gross margin was now expected to be 20.1% to 21.1%, a sharp decline from the previous range of 28% to 31%. So, why did these issues in Europe impact NFACE stock price so dramatically? It's worth noting that this ripple effect isn't uncommon in the stock market. When a major player like SolarEdge stumbles, it can trigger a domino effect, affecting not only SolarEdge but also companies like NFACE. The analyst community had already anticipated these challenges, with Scotiabank noting the difficulty in foreseeing a path to improvement in the macroeconomic environment over the next 2 to 3 quarters. This situation is also exacerbated by a destocking cycle in Europe, which appears to be mirroring the challenges faced by SolarEdge, albeit with a slight lag. Let's take a closer look at NFACE's numbers. Despite the recent downturn, NFACE remains a fundamentally sound company. In the most recent quarter, they reported quarterly revenue of $551.6 million, which, although a drop compared to previous figures, still falls within their own guidance range. They shipped 3,952,839 microinverters, approximately 1,158,856 MW DC, and 86.2 MWh of IQ batteries. Their GAAP gross margin stands at 47.5%, while non-GAAP gross margin is slightly higher at 48.4%. Importantly, the company remains profitable, with GAAP operating income of $118 million and non-GAAP operating income of $167.6 million. The positive free cash flow of $122 million leaves them with cash, cash equivalent, and marketable securities of $1.78 billion. This demonstrates that NFACE has a solid financial footing, even in challenging market conditions. Now, it's important to consider what these figures might mean for the future. While the current landscape is tough, NFACE is well positioned to benefit from the increasing adoption of energy storage solutions, solar roofs, and related technologies. Their long-term prospects look promising. Still, it's crucial to understand that the stock's current valuation is down 16.3% year-to-date and over 65% from its peak. While it may appear cheap compared to its 5-year mean, it's essential to remember that the business had tailwinds during that period, which have now turned into headwinds. The outlook for NFACE isn't overly optimistic for the short term. They expect revenue in the fourth quarter to fall within the range of $300 to $350 million, marking a significant drop from the previous quarter. Gross margin is expected to be between 46% and 49%, with IRA benefit of 38% to 41% before net IRA benefit. Non-GAAP gross margin is projected to be in the range of 48% to 51%, also before net IRA benefits. When we look at the stock's performance, it's clear that investors are worried. The stock has declined by nearly 55% since the last earnings report, and it's currently in oversold territory, a situation we haven't seen for quite some time. However, oversold conditions don't necessarily indicate a long-term problem, especially for a company like NFACE that maintains positive free cash flow and has a solid balance sheet. In conclusion, while NFACE's recent earnings report paints a grim picture, it's essential to consider the broader context and the long-term potential of the company. The energy industry is undergoing significant changes, and companies like NFACE are well-positioned to benefit in the long run. So, if you're a potential investor in the 25 to 48-year-old age range looking for stock-related content, remember that the market can be volatile, and the current challenges faced by NFACE may not tell the whole story. Patience and a long-term perspective could be your best allies in this ever-evolving landscape. Now, I'd like to hear from everyday Americans who are watching this. What are your thoughts on NFACE's recent performance and the broader energy industry trends? Leave a comment below and share your insights. Your perspective matters, and it can help us gain a more comprehensive understanding of the situation. Disclaimer: this content is for informational purposes only and should not be considered as financial or investment advice. Always conduct your research and consult with a financial advisor before making investment decisions.
Before you go, help us by smashing that YouTube like button. And subscribe to this channel, so you won't miss any of our videos. This shows YouTube algorithm that you value our information, and it helps us spread the message. Sharing is caring.